quick question. We've already heard what Lippier Award is, but can you actually explain on your side what it means to you to actually win that award? Thank you.
You know, it's pretty straightforward, and I think all three of us are in the same camp. We all take care of families, and there's a lot of people in our industry who really are not focused on that. They're focused on managing pension funds or big institutional pools. And I think one of the things that I learned early in my career was that the objectives of a private investor are really very different than those of a pension fund or an institution. Because the reality is, we're all a little emotional about this little pile of capital that we've built. And while we're all looking for some kind of return, the fact is we're a little emotional, and it has to come to us with return characteristics that we can live with. So it's great to say over a long period of time we'll all live through the ups and the downs, but the reality is lots won't. So to me, what the Lipper meant was, at the end of the day, it was that we generated strong results, but the way that Lipper looks at things, it was that it came with a risk characteristic that was muted. And that means that when you go through some of the trouble we've been going through, you know, we've been fortunate enough to keep people in the mindset that allowed them to stay invested. And so that's really what was important to us. So I want to appreciate everybody sticking around here. I was outside about half an hour ago for a breath of air, and I thought to myself, I can't believe half of you aren't on the golf course. You know, I come from Toronto. Barometer Capital Management's team is there, and I get to come out here once in a while. I realized as I watched the beginning of the discussion, of the three portfolio managers, the one with a home here in the Okanagan is the smart one without a tie. So I'm just going to start by taking my tie off. As you'll understand as we go along, a big part of our strategy is understanding the market you're operating in and making sure the portfolio makes sense. So I'm going to start there. What I was asked to do today was talk through some of the strategies that we use at Barometer and how we go about looking at the world and how we go about making decisions, and then sort of through those lenses talk about the current environment, because, you know, clearly we all read the paper every day and it's tricky out there. And you know, there's a lot of people in our industry who spend a lot of time forecasting what will happen over the next few years and what should happen. The fact is we live in the present. But I have found that if you have spent a lot of time like I have looking at history, it helps you to understand some of the outcomes. What are the possibilities? And if you can understand those, then you can address them based on probabilities and try and learn from that. Now, history doesn't repeat itself, but it rhymes a lot. And so I think it's really important. Now, I want to start just putting a framework on things by throwing up on the screen a picture of the Dow Jones over the period from 1982 to 2000. Now, we're all a product of our own experiences. We learn things based on what we've been through. And frankly, our industry largely was built during this period in a pretty good stock market. And so by the end of the 1990s, there was an overwhelming view that if you bought good quality companies and held them over a long period of time, you were going to do just fine. Asset class would take care of itself. And so it really shouldn't have been a surprise in 2000 when the tech bubble burst. The stock market rolled over. Everybody said, look, sit tight. Any time over the last 20 years, market pulled back, it was time to buy some more. And then people got creamed for the next 3 years. Now, markets covered a lot of territory. There have been some really good rallies. There have been some really good industries to make money in. But if you were the buyer, for instance, of the US market, you had a difficult time over that period of time, not to mention the fact almost any market had lots of volatility. So we get asked, often, you know, you talk about history, how can you look at the current events we're living through and compare them to history, because really these macro issues are so big, you know, and unpredictable. And the fact is, you know, there are lots of issues that we face, but human behavior repeats itself over and over again. And the causes of the behavior change, but the behavior does repeat. And so realistically, what we've been going through is not so dissimilar to other periods in time we faced along the way. So this is the Dow going back to 1896. And there's some wonderful long green periods, multi-year periods where due to some shift in the economy, you had a long run up in share prices. And in every case, at some point, asset prices wound up overowned and overpriced, and we went through years of sideways, more cyclical, choppy markets, as earnings continued to grow, but what we were willing to pay for them was slowly reduced as over-ownership was washed out in favor of other assets. Each one of the declines shaking out a few more investors until ultimately the asset class is so under-owned and underpriced that it can support another long rise at some point. So we've been about 12 years, and I can't tell you how long it will go on for. Maybe it's over. You know, maybe we're onward and upward from here. I'm not making a bet on that, but it could be. Or it could be like in other periods of 15 or 17 or 20 years that we could have another few years to go. Now, in this kind of environment, two things become a lot more important. First of all, for those who are going to be in equities, and not everybody will be, the strategies have to be a lot more tactical. You have to have some ability to take advantage of strength wherever it comes from without a bias, and it could be certain industries, like last few years resources have been pretty good, dividend payers have been pretty good. But you also have to have had an ability to play defense from time to time, to avoid certain parts of the market. In fact, some points be out of the market. And in doing that, add some additional value and keep people in a place where they can stay invested. The second thing that becomes important in periods like this is that the longer into these more difficult periods you go, the more demand there is for yield. And so yield investing turns out to be a pretty important place. And it's not just because demand changes, but actually CEOs start to recognize, because there is that additional demand for yield, that they might benefit in the market by having a very clear and well-defined dividend policy. So I really think you can say, over the long period of time, stocks go up, and it's true. Or you could say, over time, we're going to see every kind of market environment you can imagine. Portfolios have to look quite different from time to time to be successful. So given that our clients are families, and we take care of a number of families across the country, we have a tough job because there's an expectation of getting a result. Obviously, everybody wants to make a return in their portfolios. But it has to come in a package that's acceptable. So what I've found is if you say to somebody, we'll make money for you over the next 5 years, but it's going to take us year 5 to do it, well, the clients will have gone by then. And so when things are pretty good, there is an expectation we'll have some process to identify the productive parts of the market and take advantage of them. We have to be able to recognize change when certain industries start to go out of favor and other industries come into favor, so we can reposition the portfolios in a timely way. And then the third thing is you recognize, especially in the last few years, there are times when very little's working, and maybe you have to have an ability to be out of certain parts of the market or on the sidelines at times. So this is really what we try and get accomplished, and what we sell is a process. You know, we are not forecasters. I don't have some magic crystal ball, but we've got a set of tools that have helped us to do a couple things. One, find good ideas, things that are good getting better. And then second, a set of tools that help us understand the market environment we're operating in to say, should we be making new investments right now, yes or no? And if so, which areas should we target, which ones maybe can we avoid? There's a great study that was done by an economist named Benjamin King, who looked at a long period of market history and found that over time, 80% of return in the market can be attributed back to the impact of the market itself. Is it constructive or not? And then second, the industries you've targeted in your portfolios. And about 20% of return is specific just to the underlying business characteristics of the individual security. So think back to 2003. If you'd gone and bought any company in the world with the word oil in the name, chances were you were going to do pretty well. You had a pretty good stock market coming at you. You had a tailwind, rising oil prices. You're in the right neighborhood. Some better, some worse, but you're probably going to make some money. Fast forward to 2008, and by the top recommendation of the top bank analyst in the world, and it was going to be a rotten 18 months. Right? Tough market, tough industry. So really important to find good ideas, but also very important to understand the market environment we're operating in to make sure we're targeting the right areas, and that shifts over time. So what's working right now may change over time, so I think you need to have mandates and portfolios with flexibility enough that you can change the holdings and change the makeup as time goes along to be able to deal with it. So Barometer is a team of investment professionals. We have all in about 30 folks in the business. About half of us are in the investment team. I'm the chief strategist, my partner Greg, chief portfolio manager. We've got a team of analysts underneath us, a very strong trading team, and really all we sell is this process. And it's a set of steps to make decisions, and I'm going to try and give you a sense for it and then walk you through what we're doing now to give you a sense for what we're seeing through our lenses. We started originally with an equity strategy, and I'm really not here to talk specifically equity investing, but $1 million invested at inception in 1991 when I started the company. Today is about 15 million versus the market about 5 million over the period. So it's done quite well on a relative basis. A couple things that have been important. It's had quite muted volatility relative to the market. Of the 6 big down years over the period, we've been able to protect capital pretty well. The second thing was it worked well through each of the rolling 5-year periods. And the reality is our industry has tended to push managers to focus on one specific corner of the world and stick to it, like say growth investing or value investing, which can be great at certain points in time, but we know what works changes, so you need some flexibility. Now, in 2000, market rolled over, and we'd not like to go back to a period like then. Stock prices started to fall, earnings multiples started to compress, and about 6 months into it, we were sitting with a lot of cash in our portfolios trying to figure out how we're going to generate a result. My partner Greg turned to me one day and he said, Dave, you know, in the screening I'm doing, I keep running across these income-producing securities that are behaving pretty well. Why don't we take the equity strategy we're running and apply it to a basket of income-producing securities? Now, I'm 10 years younger than Greg is. I'm 48 today. And I said to him, you know, Greg, nobody cares. I said, Greg, nobody cares. People just want capital growth. And remember, think back. It was, how can I get my 20%? And he said, yeah, I know. He said, but having said that, if it gets tough enough, people will care. Now, we went back and we did some work. And we looked at these various periods. You know, in the period between 1932 and 1940, there wasn't a lot of expectation of capital growth. It came down to looking at securities and what sort of dividend yield they would pay relative to what you could get in a government bond. It was an income replacement. If you look at the period between 1966 and 82, 118% of return came from dividends. There was no capital growth. And in fact, interesting enough, the further into the period you went, the more important dividends became. By 1940, in fact, 100% of earnings were being paid out to shareholders by way of payout, because that's what motivated investors. In the period in the mid-60s, average companies paying out 65% of their earnings. So now here we are 12 years into this period we've been going through, and 86% of the return in the S&P 500s come from dividends. And the further in we've gone, the more important dividends have become. And you listen to any conference call at the end of the quarter, and the first 15 minutes are just a discussion of dividend policy, whether you're Apple or Microsoft or J&J. So you make money focusing in the areas that people care about, where there's money getting put to work. And I think in the environment we're operating in, you know, there's some pretty clear answers. So that income strategy today is 40 to 60 securities, 1 to 3% of the portfolio size. It is an actively managed portfolio, so the mix does change fairly dramatically. It yields about 6% cash on cash. We don't use any leverage. We're pretty risk averse. The goal is not just specifically to get a yield, as Sandy talked about earlier and John spoke about earlier. It's really more about finding dividend growth. And specifically in all of our strategies, it's about finding good getting better, where you're starting from a strong position, but where through some change in the industry or the business, there's an improved ability to pay a higher dividend, or in our case of corporate bonds, which are part of our portfolios at times, improving credit risk. We can be in any type of security, and while we do have lots of dividend payers as it is today, there are times we believe you need to have the ability to be in bonds, and specifically sometimes government bonds. Maybe in a more risk-averse environment like 2008, where we had to hold 60% of our portfolio in short-term deposits. But it does range in things that pay us a yield. Most of the folks we take care of are people who have built businesses over time. They've got some little pile of capital that came from that. How they generated their wealth was generating cash flow from the business. And that's the goal here in the portfolio, generate cash on a regular basis. Income portfolio, having been through now 10 years, returned a little over 14% a year, which we're very proud of. I think it puts us in the top few in the country over that period. Similar to the equity strategy, it's been quite consistent. And at the end of the day, our investors care about getting a cash flow and some income and inflation protection. $1 million invested at inception today is about $4.4 million. It's paid about $1.8 million out in income along the way. You would need to have today $1.2 million to have beaten inflation. So I think it's doing its job along the way. The last thing is, and I think this is important because we all talk about how low interest rates are currently, what might happen in a rising rate environment. And while we don't think that we're going to see that in the near term, you do have to have the ability to fight the odd bout of rising inflation. And this type of portfolio has an ability to target specific types of security where there's pricing power, the ability to raise price, increase earnings, grow dividends, and offset inflation. So there have been 3 periods of rising rates, albeit short ones, in the last 5 years. In each case, certainly bond prices fell, and we're able to grow the net asset value through those periods by focusing in some of those areas that benefit from that environment. So just quickly from a strategy standpoint, and then we'll get to sort of current markets. If 80% of return comes from market and sector, we've got one set of tools that help us to look at a broad number of universes, asset classes and industries and markets, and try and identify pockets of the market that are seeing net new inflows of capital. We don't try and forecast, we use tools to help to understand the current market environment and then make sure our portfolios make sense given what we know. So let's call those areas of market leadership, and that changes. Certain industries, certain themes, certain styles, certain asset classes. And then from the other end of the spectrum, we got to find the opportunities where we think we can get an outsized return, something good getting better, a revaluation candidate. And we take a broad universe of securities, about 66,000 securities, and look at a combination of about 20 business factors, trying to identify those market leaders. We can find specific securities that meet the business test and they line up with parts of the market that are seeing net inflows that we believe are timely. That's where our portfolio should lie. And that's pretty straightforward. But the last thing is, as portfolio managers, John and Sandy and I, we're inventory managers. And so a big part of our job is making sure we've got the tools to carve out the inventory that isn't working. Now, all of us, by nature aren't good sellers, because you invest in something originally because you like it or you think it's good. But at some point on every investment, you have to decide something's changing and be prepared to leave. But if you wait till it's obvious, you're too late. So the third piece of our strategy, which is somewhat unique, is that we run stop losses on all of our portfolio positions. In other words, before we enter, we identify a price below the price we're paying where we're going to exit if the position doesn't work. Because the reality is, we all know investing isn't about being perfect. We all make mistakes. You just have to make sure they're not big ones. So while we've done all of our work and we think we're investing for all the right reasons, we recognize things can change. If we pay $20 a share for a new position and $18 is that line in the sand, that's a hard number. If we cross that price point 3 days or 3 weeks from now, our first job is not to lose your money and my family's money beside it. So as time works out and positions go as we hope or expect, we constantly will ratchet the stop losses up and behind. We reset our stops on every position we own daily. And to the extent one drops down, either because of market or sector or changing business circumstances and hits our stop loss price, the trading team is going to work their way into deciding how to exit the position. So half of the battle of making money is finding good ideas. The other is making sure you don't blow it up with mistakes. So we use stops, and along with that, we don't ever buy something that's falling in price, thinking that we know better. We want to find companies or situations where the fundamental characteristics point to something changing for the better, but where the price considerations support those views. I want to see price behaving the way it should be, given what we think we know. Because there are a lot of smart people out there, and we may not have all the information all the time. So just quickly, security selection, we're trying to find situations that are good getting better. I spent a lot of time studying statistics in university. I believe that numbers speak, and we're big believers in trying to identify characteristics that can point us to something getting better. So when I started, the majority of managers in Canada might have known top 150 companies like the back of their hand, did management interviews, build earnings models, and build portfolios out of those names. Today there's 60-odd thousand companies globally. I think you need different tools. And so we set out to use computers to help us drill down through the universe of opportunities to identify things that were more than likely doing something really right based in numbers, and then spend the time doing the research to validate the ideas. In the income portfolio, much like Sandy discussed, it's not specifically the highest yield that's going to make you money. It's finding one that's reasonable, but where there is growth. And ideally, in a situation where there's some change taking place in the industry where you could have an improved ability to grow. And so in the income strategy, it's much about the balance sheet, understanding a number of situations that point to the improved ability to pay. And we could spend a lot of time talking about boring details on specific factors that we look at, but the net of it is to drill down to a universe of situations with fundamental characteristics that point to some kind of positive change. And then make sure we understand it by building a cash flow model that we can follow on an ongoing basis. And you know, I have to give kudos to our analyst on the income portfolio of 60 investment positions that we own. About 40 of them currently are dividend payers. In the fourth quarter, 20 of them raised dividends or distributions. And the first quarter, 13 additional ones raised dividends or distributions. So if you can get a 6%-ish yield, and the majority of them grow the dividend each year, then you're going to wind up with total return that winds up being pretty good. The other piece of it, though, is making sure that you target the right parts of the market and that you manage your exposures, because I think, frankly, the folks that are hiring us look at us to be the expert to structure the portfolio based on current market conditions. And if we wind up in a really tough market, a lot of folks expect us to play some defense. So obviously our job is to generate a result, so we spend a lot of the time fully invested. But when our work points to a deteriorating environment, we do behave a little bit differently. We will raise a little bit of cash. We will tighten up the stop losses on the underlying positions just to reduce our tolerance for risk. And to the extent we start getting stopped out of existing positions in a falling market, the cash position will stay on the sidelines. Now, it tends to be that it's not the first month of a decline that really gets you. It's month 3, 4, 5, 6, where the things really start to come off the rails and people get emotional. If you're running stop losses and the positions start to get hit early in their decline and the cash position builds, you get to a point where it's hard to lose a bunch of money. So the question is, how do we go about doing that? And I won't go into great detail other than to point out something that's very straightforward. If this was an index like the TSX, as you go through a decline, everything doesn't sell off on the first day. The weakest securities sell off first. You don't run out and sell your favorite positions. So often while the leading securities look pretty good, the weaklings start to sell off. And as you get further into a decline, more and more securities participate until late in the decline you get to that point where, we've all been there, the news is terrible, confidence is really low, there's 50 reasons why it'd be nuts to buy stocks. And if something isn't going down by then, it's not a fluke. They're doing something right. Collectively, folks in the market have decided these guys know what they're doing. When the most aggressive folks put money to work, they don't run out and buy moose pasture mines in Alberta first. They buy the things they're most confident in, and often that's those securities that have held up well in price. So often while the market continues to decline, a few of the stronger securities turn up early, like Apple did in October 2008. If enough securities turn higher, pretty soon the index is going higher, and as you go through an advance, one by one, securities join the rally. Till late in an advance, everything's working. Now the problem is, we've all been there, this is when it feels great, and the news is good. And it's easy to make money. The problem is there's good securities going up and not so good ones. Late in an advance, you get to that point where almost everything's working, and the most conservative folks decide it's time to raise some cash. They don't sell their favorite ones first, they sell the ones they have doubts about. So often while the leaders go on to make new highs, one by one the weaklings start to fall away. But you're not reading about that in the paper. You're reading about Apple making a new high. But if enough securities roll over, pretty soon market's going the other way. So we run a process that tracks across 60-odd thousand companies and a number of different universes the percentage of securities that are performing well from a price standpoint at any given time. We know the really good entry points are when you get to a point where almost nothing's working. And that in a healthy market over time, a higher and higher percentage of securities should be participating in a rally. That's money getting put to work. We know when you get to a point where 70, 80% of securities in a universe, an industry, or an asset class are performing well, risk is getting higher. People are pretty positive. Prices are probably pretty high. And when you start to see that breadth deteriorate, to us that means, it may not mean that we're going into a big decline, it just means there's not enough new money getting put to work or there's enough money leaving the market where risk reward is changing. So we run this process on a daily basis at the asset class level to say, for instance, in the stock market, do we have constructive behavior? If we do, which industries give us good entry points, ones that are unloved and under-owned and probably reasonably priced? And on the other hand, which parts of the market should we be leaving? And then we run our stop losses and we'll stay in positions as long as they work, but be prepared to go when the time comes. So it's not about forecasting, it's just a boring process that we walk through daily that lets us re-establish our view on every position every day in the portfolio construction to say, does it make sense given what we see going on right now? Okay, so let's just talk about current environment. We've been going through this period over the last 12 years that has been very difficult. Canada certainly has been a lot better because of the influence through the majority of the decade of resource stocks and our exposure to emerging markets. So you had to pick your spots. There was certainly ability to make money in the US market over the period of time if you identified the right sectors. But just being an index investor was a tricky proposition. And each one of these declines, a bunch of people who maybe didn't have it right got shaken out, and appetites changed. And we're now at a point where there's a lot of demand for yield. In fact, you look back and it's amazing. Over the last 5 years, almost $1 trillion has worked its way into the bond market, and about $400 billion has worked its way out of equities. Now, in simple terms, you make money focusing in parts of the market that are seeing net inflows of capital, not net outflows of capital. You'd think if we were in a more normal market environment, after 3 reasonably decent years for equities, you'd have money working its way back to equities. But of course, over the past year, on a monthly basis, pretty consistently, money coming out of stocks into bonds. So we know where the demand is. And it's not just from folks like you. It is now today, certainly folks like the pension funds and institutions. The problem they face is, as you saw earlier, interest rates are at a century low. And this is US bond rates as opposed to what John put up, Canadian bond rates. And you can say, yes, there is limited upside at this point, but maybe there's a mistake in saying rates have to go higher from here, because you know when we got here in the early 1940s, in the US interest rate stayed between 2.25% and 2.75% for about 14 years. So what happened through this period was that equities became an income replacement. Right? They stayed down for a long time. People started to look for other sources of income. In fact, it's quite similar to today because that was a period of financial repression where governments were up to their ears in debt due to the war. They had to find some way to manage that debt, and interest rates stayed low. So I'm not here to forecast interest rates. They are very low. They could stay down here for a long time. The problem is, as you know, when you look at your bank account, if you're getting interest at 2%, and inflation is slightly more, you're losing money. Forget about the tax issues. So that's a problem. So we all have different strategies. We all arrive at things differently, but where we've arrived is probably the same spot. Our view is that the opportunity currently, and what the market is accepting of currently, is dividend returns. Now, there is opportunity there, and I would agree with Sandy and John, there is headroom here. If over most of my career, the dividend yield in the S&P 500 was well below what you could get in a 10-year bond, because of course you expected dividend growth and you expected some capital growth. We've got to a point where we're so risk averse, where the dividend yield on the S&P, the average company, is significantly in excess of what you can get in a 10-year bond. So you're getting paid a good premium, risk premium for taking that risk. Now that's only great so long as you think you're going to get paid, and so long as you think you're going to get dividend growth. So let's look at that. If you took the average company in the S&P 500, now close to 7% of the average balance sheet, the 7% of the total value of big US businesses is held in cash, sitting in short-term deposits. So that's more cash than at any time in the last 50 years. And there's reasons for that. They haven't had to make lots of capital investments, not a lot of growth in the economy. They've been making fewer mergers and acquisitions. But certainly cash is built because they're concerned that they may not have an ability to raise capital in debt markets if there were to be another financial crunch. What's more interesting is it's been growing 60% year over year over the last 3 years. So dramatic increase in cash. There's cash there they could pay us. It's certainly growing rapidly. The question is whether they're willing to pay us. Now this looks at the US market. Over time, the amount of dividends that were paid out by the S&P 500 in the late 30s, the average company is paying out 100% of its earnings. Through the period between 1945 and say 1972, 73, companies averaged paying out somewhere between 42% and 65% of their earnings, returning capital to shareholders. After a decade, 2 decades of sole focus on capital growth through the 80s and the 90s, dividends became less and less relevant, and we're now at the point where the average company is paying out 26, 27% of its earnings. So certainly they could be paying us more if there was a willingness to do so. They do have cash and they're growing at a rapid rate. So it's interesting, last year there was a 14% year-over-year increase in dividends paid by S&P companies. They started to recognize there is benefit in doing that. We do get benefit in the market in our share price if we increase our dividends. And that's not been lost on investors. It's not been lost on other markets as well. This happened in the late 1950s. So in the late 1950s, in a period of long, low, extended interest rates, corporations started to recognize was value in increasing the amount they were paying out. Coca-Cola, for instance, worked its payout ratio, the amount of their earnings they were paying out, to 82%. Share price responded accordingly. IBM did the same thing. Procter & Gamble did the same thing. And it led you toward that period we talked about earlier, the Nifty 50, where the most secure, strong balance sheets, the biggest companies, got a lot of the investing public's interest. And they used that earnings power and that balance sheet to increase dividend growth. So last year, similar to that period, of all the things you could do with cash, mergers and acquisitions, that was a net negative for share price. Making investments in new capital expenditures, net negative. Share buybacks were positive. The most constructive thing management could do with their cash was to increase the dividends as it relates to their market value. So we think that this is something that is likely to continue. And I think that it's obvious the benefit when you look at the remarkable week-to-week volatility in the stock market through last fall. I said to one of my analysts, I don't recall seeing this kind of volatility previously in my career. There were 9 declines of between 5 and 15%, and 9 advances of between 5 and 20% in the period from August to December, each of them over 1 to 3 week periods. Right? You have to go back to early 1930s to find a few months with that kind of volatility. It was extraordinary. And frankly, I think it was being driven by deleveraging, disinflationary markets on one hand, and policy responses coming from the governments who would like to foster a little inflation on the other side, and that push-pull created great volatility. Well, unlike 2008, where we saw great volatility, income-oriented securities sailed along through that period. It speaks to the fact that when I talk about market leadership, one of the characteristics of market leadership is everything pulls back a little when prices go down. But if it's a true market leading part of the market, when the bid comes back, they trade right back to the highs right away. And that's exactly what the pipelines did. It's exactly what the REITs did through the late part of last year. So money's working its way into equity income. It's working out of other areas of asset classes. Where do you make money? Now, I talked a lot about the average company, and average dividend payers are pretty good. We've tried to focus on good getting better, where we can get a revaluation. Let me give you an example. Through a lot of my career, pipelines have been a low single-digit growth rate fixed income replacement. High dividend yield, but virtually no growth. And over the last couple of years, they performed really well, and there's lots of people who would say, well, you know what, the valuations are too high. Relative to history, they're very expensive. And I just want to push that around a little bit. In the late 90s, we had a huge run-up in the share prices of companies in the telecom equipment business. And the reason for that was, as the internet was growing, the demand for bandwidth was so great, there wasn't enough to move the information through the web. And because of that, the companies that provided the equipment to help grow that bandwidth had the ability to price their products at almost any level. They just couldn't produce it fast enough. And there was great profitability, and the whole industry got revalued, ultimately to a ridiculous level. Well, there's a reason why so many Canadian oil companies are trading poorly recently. It's because their ability to sell their product at the right price is just not there. And the reason is they can't move the energy from the ground to the refineries. There isn't enough bandwidth in the midstream energy infrastructure industry. So I look at pipelines and I say, yeah, it's great we get the dividend yield, but there's a once in a generation increase in volumes that are giving them an opportunity to grow. I know you can't read this, but this is a summary of all of the oil sands projects that come into production between 2011 and 2020. What that sums up to is going from about 1.5 million barrels a day to 4.5 million barrels a day by 2020. That is not a low single-digit growth rate. So if you can get a 4 or 5% dividend and you get that kind of volume increase, there's an opportunity to see a much accelerated dividend growth, and you can see the industry get revalued. So a couple of ways you can invest in energy. One is you buy oil companies and hope that they get the world price and hope that they can get it out of the ground for the right price and hope they don't have environmental problems, or you can just say, I'm just going to move this stuff back and forth and charge a tariff. And I think that the midstream energy companies have this ability to get paid, to grow volumes, and grow their dividends. So there's a reason why, against a very tough market, the pipelines steadily rising in price, steadily growing their dividends, and why Enbridge can come out and say, we will grow our dividend 15% a year for the next 3 years. There's a change taking place. The REIT index is similar. Companies like Target coming to Canada need space, and as John so well pointed out, the real estate investment trusts are largely occupied. So with additional demand, it gives them pricing power. Yield plus some kind of change in the industry gives you a revaluation. So I think you have to look for these spots. We're in the kind of market where certain things are working and lots aren't. Telecom doing very well, pharmaceutical after 12 years of going from being highly valued and overowned to unloved and probably underpriced. Changes taking place, yields can go higher, and the share prices are going higher. So we spend our time looking for these spaces. I'm not telling you this is where we will be always. Different types of income securities make sense at different times, and our job is to try and identify those. So you can be there, or we can say, let's go buy the index, which is what you're getting here. And it's not because everything's doing poorly, but certain industries are really in tough shape. We're all a product of our own experiences. I understand why people ask, the first question is, when is it time to go back and buy the metal stocks, Teck Resources or Suncor? I can't tell you when it will be, and we don't try and forecast that. I want to see a change for the better before we're going to enter. And some of those characteristics we talked about earlier. So portfolios change. The goal is to generate a return, a little bit of growth along the way. This strategy, fortunately, has worked through every rolling 4-year period since inception. And probably most importantly, if you took all of the income funds in the category and put them in a basket, as Morningstar did, and ranked them return on one axis versus the volatility you had to live with to get it over the previous 5 years, the goal is to be up in this category here, which is where the Barometer Income Fund has lived, the Lakeview Income Fund, and the portfolios that we run on behalf of Raymond James. So I'll go back here just to wrap up. These periods are really tough. I know it's not easy to make money. You have to work hard to find your spots. And I would like to think after 12 years, maybe we're onward and upward from here, but I just don't see that in the history, and I think there's enough reason to believe that deleveraging could take some additional time to unfold. So we're all young enough that we're going to get to that next secular bull market. It will come. We just have to make sure we get there intact. And we have to make sure that we have strategies that work in this environment, not in some other environment where we go back to great capital growth. So if you go back and look at this period here, the 1966 to 82 period, 17 years, it looks like the market goes nowhere. And yes, the long-term slope is upward, but let's put it under the microscope and see how we'd feel about it. In 1966, the market fell 25% in 9 months after being very good for a long time. So most people lived through that. They said, it's okay, I can live with that. Market turned around, rallied 32% over the next 2 years. That's a cyclical rally. Then it fell 35% over 18 months, and a bunch of people said, oh, that's not very good. I think I'm done. But most people stayed in. Market rallied 66% over 3 years, another great cyclical rally. You can make a lot of money. But in the 1973-74 bear market, the market fell 45% over 23 months, not too dissimilar from the bear market we went through in 2008-9. And the world looked like it was coming to an end. But at that moment where we went to a lower low, market reversed and rallied 75% over 2 years. Not far off 100% rally over 3 that we've just been through, back up to this top end of the range. Wasn't enough growth, market rolled over, fell 26%. Every one of these red periods washed out more equity investors who just said, I want to do something else. Show me a different kind of return. And ultimately, by 1981-82, the market was trading at 6, 7, 8 times earnings. So I know we talk about the market being cheap here at 12 times. It can go to 8. And I'm not saying it's going to. You have to understand the range of possibilities, what can happen. So when I look at the environment we're in, we've been sort of range bound over the last 12 years. I think it's very possible we are going to see additional difficulties coming out of Europe. So we have to pick spots that are working and find strategies that can manage their way through these times. I'm not saying what we do is perfect. In our equity strategy, if somebody had done exactly what they were told in 2000, and taken $1 million, put 70% in the TSX, and 30% in the S&P 500 as a Canadian, bought and held, lived through the ups and the downs, paid no fees because they were in the index, so they saved that money. They made 3.1% a year to December of last year, and that's just not enough. So that strategy isn't working. You know, we've certainly had better months and worse months over the same period of time. It's 9.5% a year, 196% cumulative in the equity strategy, with a lot less volatility. If somebody had been in the income strategy, the better place to be, about 14% a year, about 330% cumulative over the period with one negative year, minus 10 in 2008. We were fortunate, we ranked number 1 in Canada in 2008. And I think the reality is we need to find things that work in this market. So the common thread in the presentations you heard today, and we're all coming at it from different angles, is that as it stands today, yield investing probably the place to be. I don't see major threats to that theme in the foreseeable future. We each have strategies that are flexible enough that allow us to target different areas because different things will work at different times. And we just have to keep questioning that every day to say, does it continue to make sense? And that's what our team spends their time doing. So I've been giving this talk now for about 10, 12 years. When I started, I was battling 20 years of buy and hold investing, having been successful. And people would say, well, it sounds like a great strategy, Dave, but you know, what we're doing is working. I've got my banks and my insurance companies, and I'm just fine. I think today there's a far greater acceptance, if not expectation, that managers will take responsibility for, finding good ideas, but also managing exposure based on conditions and being able to transition portfolios without a bias to different types of assets and be able to ask that question regularly. I don't think people are looking for someone who can mirror an index, because you can go buy an ETF to do that and not pay a fee for it. And I think the most important thing that you heard today was that it's very clear we all have an expectation of getting a result, but we're spending a lot more time thinking about the risk we take on to get it. So that's all I've got to say. I hope there's been some reasonable content in there, and I'm happy to answer any questions that you might have.
That was excellent. Do you use a percentage to set stop losses? And what is that percentage?
So to be clear, the idea of using a stop loss is to make sure that you don't get emotional and rationalize why something isn't working. And we do have a luxury. Our portfolios are not, multi-billion dollars in size, so we can move it around a little bit. There's lots of ways to set stops. Many people do use a percentage like 7%. And the reality is it's a little bit simple because every single security has a different personality. Some much more volatile than others. Ideally, what you want to do is have some process to help you identify change points where, due to changing behavior, something is changing in the way a security has behaved over a long period of time. So we use an old-fashioned tool called a point and figure price chart, which is a longer discussion to have, but it helps us to identify statistically significant inflection points where, due to changing behavior, our odds of success are changing. Some people use moving averages. There's lots of ways. And I fortunately have a great trading team that have helped us to do that. But we use point and figure charts.
Thank you. What does deleveraging mean?
Okay. Deleveraging is where, let's take governments for instance. Governments have built up this remarkable amount of debt, and they can't continue to do it forever. So, for instance, Europe is being forced to reduce their spending and try and pay down some of that debt. Individuals have been doing that in the US. So the problem is, when you go through a period of deleveraging, whether it's at the consumer level or at the government level, it tends to be disinflationary in that there's more sellers of assets than buyers. And if there's more sellers of assets, then asset prices have a harder time going up. So that's why valuations, one of the reasons why valuations for assets have been getting compressed. On the other side, you have central bankers who are working very hard at making sure it doesn't turn into deflation. And so they're working very hard and being pushed by people like Ben Bernanke to use monetary policy to reduce the cost of credit, to try and entice people to buy assets. So you have this push-pull going on. And I read a really good article in the Globe this morning because it talked about how in a very long time we haven't had the amount of meddling going on in markets by policymakers. And it makes it tricky to value an asset. Because if you've got all of this stimulus being pushed in, if you look at last fall, financial markets were in a really tough spot. And the extreme amount of liquidity that was pushed into the market to try and encourage banks to get bad bonds off their balance sheet, get cash from the ECB to put on their balance sheet to turn around and buy more of the bonds that were the problem in the first place, that's policy meddling. So we're going through this deleveraging process. Think about your own personal situation. A balance sheet problem takes a lot longer to fix than an income statement problem. Right? An income statement problem, you cut your expenses and you're good to go. Right? Balance sheet problem takes a long time to pay down debt. So there's going to be some restructuring and there's going to be some debt paid down, but that means that it constrains the amount of capital that's available for other things. And that possibly leads to a period where you have slightly slower growth. And then the question is, in an environment like this, what multiple, what valuation are people prepared to pay, because it's hard for them to predict the future when there's all these changes taking place.
Thank you. It seems like most of your answers are all very systematic. And it's amazing, you talked about you have a process, and I do believe that you cannot create success in any business without actually having a process. Right? Everybody has pilots have a process, scuba divers have a process to make sure your risk management is there. It's excellent. Next question, how do companies get away with paying small dividends while increasing executive compensation and cash reserves?
That's a great question. But you know, what's interesting is the market is the enforcer ultimately. And you're seeing it. You know, John recognized the opportunity in income trusts early. And my partner Greg did the same thing. And their view was that by having a strong distribution policy, it enforced management to have discipline around their decision making. Every decision had to be, will this help me grow my distribution? And that actually really helped solidify a culture in Canada of corporations paying dividends, right? So what's happening, and you see it, is companies that don't pay a dividend are trading at lower valuations than those that do. And management groups are recognizing it, and behavior is changing. So ultimately, the market becomes the enforcer. Sometimes it just takes time for that to happen, but it seems to be happening now.
You don't mind another question?
Sure, one more and then we'll...
Perfect. What is the Barometer private pooled portfolio?
So you know, we have found over time that people like to buy investment services a couple of ways. Some people really like to see every position in their portfolio, and so as a result we run separately managed accounts, and we do that for clients of Raymond James in their Partners program. You own each individual security, and if you for some reason left, they all go with you, and you sell what you want to sell and you keep what you want to keep. There are others who prefer to buy an investment in the form of a fund. Now we used to be in the mutual fund business. We capped the investors there because we felt it was beginning to grow too quickly. But we run some private pooled portfolios, which are in effect a fund that investors can buy this strategy in that's priced daily. And there are things we can do in a pool that we can't do in a separately managed account, like hedge currency or hedge market risk. And I think that the folks at Raymond James could walk you through the differences between the two, but it's like saying you can get it through door number one or door number two.
Well, since you're so good at answering questions, and it is your birthday, I have one more question for you. How can the USA handle their tremendous debt?
Well, there I don't have an answer. I think the only thing that I would say is, you know, what's going on in Europe, while it is scary in the short run and is very problematic, I think long term is really constructive, because really we are seeing, I think, the end of entitlements. And the reality is we've all been getting services that we can't afford to be getting. We all pay for them. And ultimately, the U.S. government's in a good position because they do pay their debt down back in their own currency, which is a benefit many other countries don't have. And so that's why the U.S. dollar is so strong. It's, you know, as somebody said, the cleanest dirty sheet.
Yes.
You know, the problems will hit the U.S. probably after it goes to the weaker sisters, like Ireland first, and then Greece, and then you may see it spread to Spain and France and so on. You can either restructure debt, which means restructuring just means you don't pay it and people take a big haircut, the creditors, or you can slow down the spending dramatically and balance the budget. And the third way is that you can create growth in the economy to offset the risk, and that's what the central bankers are trying to do. It's just they're having a difficulty doing it. So it's going to probably be a combination of the three.
Thank you very much.
Thank you.